Well, let's go ahead and get started. Awesome crowd, great night, great program. For those of you who don't know me, my name is Jim Barnes, and I am the president of the CFA Society of Philadelphia. And what I'd like to do is just give just a big thank you to Professor Mike Pagano for putting everything here tonight together. The panelists are going to be fantastic. The program's great. The topic is great. A lot of work, effort, time goes into putting this together. So again, Professor, thank you very much. The other thing I wanted to do, I just wanted to recognize a few individuals in tonight's audience. For those of you who don't know, next Thursday at the Union League in Philadelphia, we have our research challenge. It will be the finals, where the final four teams will compete. They will be giving a presentation on the subject company. In this case was Harscopes Corporation. There are four finalists. Those four teams are University of Delaware, Delaware State University, Bloomsburg University, and there's one other team that's going to be in it. Can anybody guess who that is? Villanova. So congratulations to all four of those teams. We're wishing the best of luck. Whoever wins there will go on to the regionals, which will be down in Atlanta. If the members from Villanova want to just take a quick stand up so people can see you. Best of luck, guys. I'm going to transition over to Professor Mike Pagano, who's going to be the moderator for tonight's program. Thank you, everybody.
Thank you, Jim. Welcome once again. This is a great opportunity. It's the first time we're doing this where we have the CFA Society co-sponsoring event here at Villanova School of Business. So welcome all of you that are not from Villanova, maybe your first time on campus here. It's great to have you folks here. And we do have a nice little networking reception, so hopefully everybody, if you don't know each other, will get to know each other quite nicely by the end of the whole day here. The School of Business, you might be familiar with, is got a little over 2,000 students, both grad and undergrad students, and been around since 1922. This building isn't 1922, but it's a good testimony to some of the kind of investments the school has made in the business school. And you may have heard about like rankings and all that stuff, but Bloomberg Business Week now has ranked us consistently in the top 25 undergrad programs in the nation here. So we're very proud of that. And it's great to have you all here to kind of mix kind of theory and practice together. So I've got an illustrious panel to the left of me. Hopefully you have this little handout from called the ETF's Past, Present, and Future. It has a little bit of bios on the various speakers here. So I'm not going to go into great detail to talk about each and every one of them as far as their great history and track record, if you will. But I do want to mention a couple things about how we're going to try to go about this here. We have, as the subject is exchange-traded funds, and so we have, I think, a really good representative panel because we have Jim Rowley, who's in the middle here, from Vanguard. And as you know, Vanguard is a world leader as far as primarily passively managed index fund management, both on mutual fund and the ETF space. And so that's obviously a big part of the whole industry, if you will. But things are kind of changing, if you will. And so there are now actively managed ETFs being developed. And so we have a good representative from that with Wes Gray to his left. So at the corner there, we have Wes kind of talking about how actively managed can maybe make an impact in this particular area. And kind of, I guess we should have moved this around. You should have been in the middle, actually, as the market maker. But we have Reggie Brown here, who is at Cantor Fitzgerald and is well known as one of the leading market makers and liquidity providers in the ETF space here. So that's kind of who we have as far as the players. I'll be the referee, kind of try to stay out of the way as much as possible. But I thought what we would do is maybe we'll start with some questions that I can kind of come up with, and maybe go down the line here. So we'll start with maybe we'll start with Jim and go a couple of questions that way, and then as you guys have questions, feel free to kind of chime in as we go along. So, and the questions for Jim, obviously Reggie and Wes can chime in as well. So the first thing I was thinking about when I thought about this subject is there are changes happening in the industry. So, what are the recent developments? What are things that have created new opportunities to tailor investment needs to investors out there in the 21st century?
When we talk about well, first of all, I'd say thank you, everybody, for your attendance and your time. It means a lot to me as a graduate here and a past president of CFA Society of Philadelphia. I remarked that the only thing that might be better is an IPA tasting convention and English Premier match, but this will have to be a good second place. I think what's important to note is taking a little bit of a retrospective here, right? Before we go forward and talk about new developments, is kind of what got us here, what's made ETFs so popular, what's turned the mutual fund industry on its head. And I think we look at three real drivers that have made this happen. Number one is financial advisors have been, if not the first, but the earliest adopters of ETFs. And one of the reasons they've done so is because over time they've been changing their business models from pure commission-based practices to fee-based, right? So instead of charging clients for the products and transactions that they incur, they charge them for advice, right? And as a result, they don't get paid by the product. That's number one. Number two is a much more, a bigger awareness of low-cost investing, right? And that's not just about indexing. As you might imagine, Vanguard is very focused on low-cost investing, but I would say that's not just about indexing, that's about active management as well. And we've done research at Vanguard that shows if you looked at cash flows into all types of funds, whether they're indexed or active, fixed income or equity, you would see the lowest cost funds gathering the most assets, right? So it's not just an indexing story, it's a low cost story. And the third driver that we think is what we would loosely refer to as open architecture, right? Probably if you look 10 years ago, 15 years ago, mutual fund distribution was done so in a supermarket model, right? You could only buy a mutual fund if your supermarket put it on its shelf, right? So I can only go get Cheerios if I walk into the store and it is on the shelf to be had. And mutual fund distribution is very much that way. Because ETFs work through brokerage accounts, your brokerage account is like Amazon.com. Like nobody can prevent you from going and getting what you want through a brokerage window. And as you had a little more independence with the financial advisor community and this pressure to develop more open architecture, you now have investors who don't have to sort of wait on what their supermarket lets them pluck off the shelf. They go to the brokerage window, they go to Amazon.com, and they have best of all breed. So again, what's got us here, we think it's a little bit of advisors migrating to fee-based businesses. We think it's this emphasis and awareness of low-cost investing, whatever that low cost might be. And third, this concept of open architecture as it pertains to fund distribution.
Thanks, Jim. Okay. Wes or
Yeah, I'm
Reggie,
just
would that chime in, or?
I would add a little bit to that is it's definitely the market certainly moved more open architecture, but as we're finding, moving into the marketplace as an active ETF provider, we have RAs all the time from the big wirehouses like Wells Fargo, Morgan Stanley, Merrill Lynch, and what will happen is the banks will literally block your ticker. So even though it's in theory open architecture, the banks and the wirehouses do like to control their supermarket space at some level. It's got a lot better. Ideally, there wouldn't be any blocks like that, but it's not completely open architecture yet, which would be nice, but that's not how the world works.
Well, I think my spin on, why ETFs over the last 25 years has gained popularity. So the ETF industry was born in Philadelphia, actually, but it was blocked by a lawsuit by McGraw-Hill and with Canada. And so the first ETF was launched in Canada on the Toronto Stock Exchange in 1990, and over that 25-year history, we have $3 trillion of assets in ETF space globally, growing at a 19% compounded growth rate year over year. And so if you think about why ETFs and why the growth, it's really been about the delivery of solutions into the marketplace and in a very transformative way. With a click of a button on a retail account, you can get access, as Jim talks about, to very simple passive strategies that gives exposure to all types of different investment themes, or also into very complex vehicles that give someone a exposure to something very complex and complicated if they understand it. And so it's really about the delivery of solutions in a self-directed manner. And if you look at the buckets of opportunity, who's using ETFs, my business is global, so we do business all around the world, talking to all types of investors. It's been the self-directed financial advisor community, intermediary, talking, giving advice for a fee, but also institutional. You have insurance companies, you have asset managers, you have family offices, pension plans around the world using ETFs for global macro exposure. And so think about it. Where else can you buy an instrument on Thailand stocks or South Korean instruments or fixed income very easily? Not to get into complexity, but the way that we as Americans get exposure to U.S. stocks has become very complex over the last 10 years. But ETFs have lowered the hurdle in that complexity perspective, buying exposure like in a basket of stocks and an ETF or in an equity wrapper, essentially. So to say it easily, it's about the delivery of solutions to the marketplace for the common person. My grandmother was a big buyer of equities, and had she been living today, she'll be a buyer of ETFs because it delivers opportunity for investors in a low-cost solution.
Yeah, I was just reading an article, you've probably seen this, where they were saying that in the U.S. now, there's now people that used to have institutional investors that had exposure to, say, the S&P 500. They would go to the futures market to do that. Now it's become cheaper to actually do it through the ETF space.
Yeah.
I don't know if that's true. And I read Financial Times was saying there's actually a shift now where institutional investors say, if I want to put just simple exposure to the S&P 500, not all ETFs, not all exposures everywhere, but at least simple U.S. equity exposure, major market, I can actually do it cheaper. Used to be always in the futures market. Now I can start to do it in the ETF actually easier and cheaper.
Well, that's a very complex phenomenon that would be very difficult in this short period of time to explain it efficiently. But the reason why that is taking place is because of regulatory enhancements in the marketplace. So with regulations post-crisis in the United States, our regulators have created a situation where it's more expensive to deploy a balance sheet from an investment bank perspective, and because of rising cost to deploy capital from institutional investor, it has shifted the cost structure of various instruments. So if you compare a future on an instrument to an ETF or a swap to an ETF, the cost structure has changed dramatically where it makes sense to use an ETF over a future that's traded on an exchange that expires every quarter, and there is a roll cost to roll from one contract month to another. And for example, the S&P 500 has a future traded in Chicago, and the roll cost in December to roll from December to March was 70 basis points of roll cost. And you compare that to, where's the Vanguard 500 ETF priced? 8 basis points, 5 basis points?
Oh, wait, guys, 6? I think I
6.
know off the top of my head.
Put you on the spot. So the Vanguard ETF is priced at 6 basis points. So if you compare 6 basis points to hold a Vanguard S&P 500 ETF to 70 basis points to have exposure into a future, you're seeing the dynamics where folks who understand cost structure are shifting to using other instruments.
And you get a double bonus with this too, right? So cost is one angle, as Reggie points out, but if you think about the exposure you want and the precision you wish to obtain it, you're going to face basis risk using a futures contract. If you go the swap route, you're buying into counterparty risk because somebody's on the other end of that trade. The overwhelming amount of assets in the ETF marketplace are in products that are registered investment companies, right? They follow the same legal, regulatory, and tax structure as mutual funds. So from an investor protection standpoint, you get the same thing you get with mutual funds. From the cost structure and the implementation, because it's a fund structure, you get much more precise, I'll call it target index or target strategy tracking, than you might with either the counterparty risk or the basis risk posed by a swap or a futures.
Yeah, and just for the general audience, the idea of a basis risk you have is the idea that the thing that you're trying to get into, the exposure, may not be exactly correlated with what's happening with that particular instrument that you're using to move from. So the case of the futures market versus where you want to be as far as the S&P 500, what's called cash index, that could actually be, you're suggesting bigger risk in the futures market than the ETF market. It's a higher correlation in the ETF market. So another reason why we see the trend in this direction. I should also mention, I should have said this in the beginning, we are video taping this experience here. So Once we have it available, we'll have that out to you guys. So if some of the stuff you need to kind of rewind and look at it again, you'll actually be able to do that. So very good. Okay, let's maybe switch gears a little bit here. We kind of touched on this a little bit, maybe for Reggie. Just thinking about what are kind of the key ingredients that you think about when you think about it. You've been obviously in a market making situation, so you're dealing with a client saying, what they're interested in buying. So what are the things that really make for a liquid and successful ETF in your opinion?
Well, I think as a qualifier, I know there's a couple folks here who know my business and what I do for a living. So as an ETF market maker, my primary job is to create a market, a two-sided market, so that investors can buy and sell efficiently using a mechanism to enter the marketplace, on a stock exchange. And I'll use stock exchange as synonymous with other types of market centers. So I make markets on market centers in the United States, in Europe, Canada, and in South America. And so if you look at it, as a pre-qualifier, I have personally in my business have launched roughly 25% of the ETF listed in the United States and also in Europe. When Vanguard wanted to launch ETFs in Europe, we were their first market maker that made markets on the London Stock Exchange that allowed them to launch their products in Europe for European investors. So my primary job is to make a two-sided market so that investors can buy and sell efficiently. So in order to do that, an ETF liquidity is predicated on the liquidity of the underlying basket or the underlying instruments inside of that trust. And so we talk about ETFs as synonymous with all asset classes, but frankly, they're all unique. So for purposes of clarity, an ETF is built on U.S. equities, fixed income across the credit curve, and international equities emerging and developed. And then you have this alternative bucket that it's kind of a mixture of just the kitchen sink, what folks cook up in the background, financial engineering. And so if an ETF basket, so an ETF is comprised of securities like a mutual fund that are priced real time on a stock exchange, disseminated every 15 seconds with a disseminated fair value. And that fair value can be ascertained looking at a number of market-centered data screens that will give you an idea what it's worth. And so for an ETF market maker or investor to get exposure into an ETF basket, it's predicated on the least liquid instrument inside the ETF basket ETF is comprised of. So we launched an ETF on Peru to allow the Peruvian pension funds to shift liquidity from Peru into the United States. And I'm using this example because the average daily volume on Peruvian securities in Peru is roughly $10 million per day, and sometimes 20. And so that ETF in the United States is only as liquid as the underlying components trading in Peru. And if you were to trade larger than the average daily volume, then you're trading larger than the available liquidity available, and you have impact into that market. So what makes an ETF attractive? So I will keep referring back to Vanguard because Vanguard is Vanguard territory.
Don't forget about Wes. He's here too.
I'm a Pennsylvania guy. I'm a Pennsylvania guy, and Wes has two ETFs that are active managed. If you were to build an ETF that had components that didn't trade readily, then the ETF itself would not trade readily. And so if you look at, there are 1,600 ETFs listed in the United States, 4,000 listed around the world, and by 105 or so different issuers and growing. And what makes that attractive is that they're delivering solutions to the marketplace, as I've touched before. But think about ETFs in comparison to mutual funds. There are 15,000 mutual funds, half are money funds, 7,500 are just other types of instruments. And you compare it to ETFs, you say, well, are there too many ETFs in the marketplace? And I would say no, because there are 7,000 mutual funds. And so there's a conversion factor there. So just think about overall, ETFs are predicated on basket liquidity and on thesis around management, whether active or passive. And as managers come up with new strategies, ETFs can be launched.
I'll add one public service announcement. Because Reggie has a really important point here, right? Noting that your tradability or liquidity of the ETF is predicated upon what's inside that basket. To flip that another way around, don't be sucked into, if you're a student here and you go to the finance lab and you pull up an ETF on the screen and you see it has very limited trading volume, that is not the indicator of the liquidity of that ETF, right? Trading volume is one aspect that might help it, but as Reggie points out, because there is a creation mechanism, right? ETFs are open-ended funds. New shares can be created. They're not closed-end funds. Just because you see a trading volume number on the screen, that is not what is the litmus test as to whether or not it's a liquid ETF.
So what is that?
It's sort of a two-pronged equation. It's some amounts of the ETF's trading volume itself and combined with the liquidity of the underlyings. So getting back to Reggie's point, right, if you have a good example might be an S&P 500 fund, and let's say it itself doesn't trade very much. Maybe it trades 1,000 shares a day. But because it's comprised of the 500 largest stocks in the United States, and the most liquid tradable securities, Reggie can have that thing created and turned around with a very large trade very easily because the underlyings are highly liquid, even though the shares of the ETF itself do not trade a lot.
Just to add on that, in Bloomberg there's actually a new function now where they try to estimate how much you could create in a given day and not have massive impact on that ETF. So some ETFs, they may have like $100 million and they've never traded a single share because what happens is a guy like Reggie, they'll create these units and just deliver the ETF securities directly to the buyer of those securities, and it never hits the tape, the traditional tape. And so we've had conversations with, say, Deutsche Bank. We have a client that's really wealthy, and they don't want to trade on the bid and ask in the secondary market. So they'll go to an AP like Reggie or Deutsche Bank and say, hey, I would like to create $10 million worth of this ETF. And they'll say, no problem. Your underlying securities are uber liquid. We can throw that on a VWAP algorithm and buy that at zero impact and give it to you at NAV pricing at the end of the day. And they'll get delivered $10 million worth of ETF in a single day, no problem. And on the actual tape in the secondary market where you're looking at your Bloomberg and your bid and ask spreads and what have you, it's just irrelevant. So it's like, as these guys are saying, it's all about the underlying, and there's other ways you can get liquidity in big-sized ETFs.
So on a given day, you may have relatively low ADV, but if you want to trade one day's ADV, if you make the right kind of savvy arrangements, if you will, and understand, you can actually, the pipe kind of gets bigger.
Yeah.
And then it goes back down again.
Yeah,
like
exactly.
like a snake swallowing whatever and then kind of digests it, right?
Yeah, exactly.
Well, I think just to, give one example. So 2 years ago, we did a very, it's a famous trade because every fixed income asset manager knows about this trade. We had a client from Europe who wanted to have exposure into high yield, and they were populating a new trust, a new investment, and the client wanted to have $1 billion of high yield securities. And over a 3-month period, including, we were part of that conversation, the client decided to use an ETF to buy $1 billion of high yield fixed income securities, and we used the ETF to do that. And so we bought the underlying basket over 4 days and accumulated $1 billion of secondary ETF liquidity, the actual ETF itself, and then bonds underneath. And we created the ETF at NAV plus 45 basis points of impact away from NAV. And then we delivered the bonds by redeeming the ETF and getting the bonds, the physical bonds, and gave it to a client. And so illustrating how ETFs work, a market maker must transact in the underlying basket of what the ETF comprises exactly, and deliver that to the ETF trust, and then the ETF trust will create new shares in lieu of getting the underlying portfolio. So market makers, such as myself, has to be learned in all asset classes: fixed income, equities, international currencies, commodities, because ETFs comprise of that, and then understanding the rule set around how the liquidity structures of those various asset classes operates. So where Wes or Jen may have multiple PMs that are running mutual funds associated around those asset classes, I have the same type of structure where you have heads of certain asset classes recreating the ETF real time. So for purposes of clarity for the students here, understanding how asset classes operate and the structure around liquidity services is paramount, and then understanding how the market structure around equities operate is tangential, and understanding how you have to operate.
Yeah, a little bit of jargon clarification. Just NAV is net asset value.
Net asset value of the mutual fund. Every mutual fund has a NAV, net asset value, as well as an ETF. Try to limit some of the jargon.
That's a question now?
Yeah, sure. We're almost at that time now where it makes
this
sense.
whole process. So when the client comes and gives you $100 million, you basically, if it's the S&P 500, you have to go out and buy $100 million of those stocks in the S&P 500 and deliver them into the trust?
That's correct.
So it really works that way.
Just that clean.
So on the fixed income side, how do you do that? I mean, you can't get all those bonds, right? You can buy the stocks, but you can't buy all the bonds in a representative index, or can you?
Well, so yes, you can, and that's one. So the question is, if someone had to buy the equity underlying like SP 500, and I basically buy the basket very efficiently and deliver it to a trust, is that the same way for fixed income, given the liquidity surface of fixed income and finding available bonds? And it's the same mechanism. You have to find all the bonds that comprise the ETF and deliver that underlying bonds to the ETF for exchange of ETF shares. So it's the same process.
Yeah, and I think you were talking about that $1 billion high yield bond trade. You don't do that in a snap of a finger. It took 4 days and
It took
a
4
lot of
days.
savvy training to make that happen. That's not. But whereas you do the S&P 500, you can do it much liquid. You can do it almost mechanically.
Right. And I mean, so simplistically, it functions that way on the buy, on the sell side.
That's correct. It's the same way if you were to give Alpha Architects $100 million of your money, they're going to put that money to work right away. I'm giving a plug right away, and so it is not to the benefit to have cash sitting in this portfolio, because that creates drag. So any portfolio manager is going to deploy new money coming to the fund immediately, and then it's the nuance of the PM in deploying new cash or raising cash to give for redemptions. It's that nuance that's part of tracking a benchmark and portfolio management.
And so you will put that money to work in the actual underlying instrument. You won't use a derivative or any kind of synthetic thing to give yourself some time or to buffer what you're doing?
It depends on my rule set. So if a client, so I'm transactional. If you said, make me a two-sided market of buying $100 million of X, I'll make a two-sided market. I'll make a transaction. I'll sell it to you. And then what I do next is, in order to hedge my risk, I must buy the underlying basket and to be always neutral as far as risk in the marketplace. And if I can't find the available basket, I will trade other instruments that have a high correlation to my risk exposure.
Just switch gears a little bit here. Maybe one for Wes here. Just thinking about kind of the actively managed spaces, which is what Alpha Architect and what, as I mentioned earlier, Wes's firm is specialized in, kind of taking a quantitative approach, try to look at things from a more systematic way, kind of take away some of what's called the behavioral finance biases, if you will. So he's got a very interesting kind of firm. I'm sure we'll talk a little bit about that. But just for me, more generally, just thinking about what role should actively managed ETFs play in the market space here? It's been primarily, I don't know if you have the statistics, the overwhelming percentage is passively managed at this point. So there's only a small little fraction that's actively managed. So what role should it play, and how's it going to maybe evolve? Obviously, unless you're in the forefront of that right now.
So one thing a lot of people don't understand about active management is it's really not about providing performance. It's about providing product to the marketplace and having salespeople distribute that product, right? And that's how mutual fund businesses are built. They're not R&D shops. They are product distribution shops, right? So the problem, and that's a great model because the banks love it, mutual funds love it because they have this thing called a transfer agent file, right? So actively managed mutual funds or, products that get built by a bank, it's very easy when a sales guy sells that product to Joe. Joe will show up on my transfer file. I can say, oh, Joe bought $10,000. Let's give Joe a kickback, right? And so the whole active space has been driven off of distribution and ability to pay off third parties to basically pump your product out the door, right? And what's a challenge with ETFs is there is no traditional transfer agent file. The only guy I know who I trade with is Reggie. But Reggie could have done $1 billion trade with hundreds and hundreds of traders out in the marketplace. I will never know who actually bought my ETF, which means as an active ETF sponsor, it's very difficult for us to hire third-party hired guns to go jam product into people's faces, which just like Vanguard did in passive, where they built a model of direct-to-consumer, we're trying to do that in active. And by doing that, you rip out a huge part of the value chain, which is the third-party distribution cost, which is why hedge funds cost 2 and 20 and not 100 basis points. It's why mutual funds cost 150 bips, not 75 basis points, because that whole business in active management is structured to pay off the sales guys. Active ETFs don't facilitate that yet, which is why we're in the space because we like it because it has a structural advantage if you can figure out how to be a direct-to-consumer sales shop. Where traditional active managers, they don't like that model because they've invested billions of dollars in salespeople, not PhD guys that do research all the time. So we like it because we think it's disruptive to the entire active management industry. And that's why you only see guys like us in active ETFs right now, and you're not seeing all the 800-pound gorillas because they're like, how do we get our sales guys paid? And they're going to figure it out, I'm sure, because they're not stupid. But we feel like we have an opportunity right now where we can exploit this kind of structural edge in the marketplace. Which Vanguard obviously did that very well in the passive side. Because you guys don't have any third-party distributors, right? Or third-party salespeople.
Biggest growing part of our company.
Oh, now you guys are getting into that.
For the past decade, working through financial intermediaries is by far the biggest driver of our ETF business and just fund flows overall.
Yeah.
Although Wes brings up a really good point here that, and I alluded to it in the beginning, right? This is largely about a distribution mechanism, right? The overwhelming, I'll say it again, the overwhelming amount of ETFs out there are 40 Act funds, right? The same legal entity structure that mutual funds follow, but it's just a different distribution mechanism. It is no longer working through, necessarily all supermarkets and third parties. You can have a direct line of sight, right? You might not be able to see necessarily who the end buyer is, but the brokerage window has cut the distance. Whether it's an individual or you work through a financial professional, you still have shortened the distance through distribution. So that's clearly seen as a big advantage to some of the big, all investment managers. This is a new distribution channel for us. Mm-hmm. And, probably the other element that goes with this, and we see a lot of the active management space sort of towing the entry line, you need what's called, exemptions to turn what is otherwise a mutual fund into an ETF. And without all the additional stuff that goes with it, one of those exemptions is if you are going to have an actively managed ETF, you need to disclose your portfolio holdings every single day. There are some active managers that are okay with that, and there's a whole lot more that are not okay with that. And as of right now, distribution being one for some, but little bit of this hang-up being, I don't know, as an active manager, those that are comfortable agreeing to fully display their portfolio holdings every single day.
Yeah, I'd like to speak to that point, actually.
Sure.
So one of the things that's interesting is we came out of the high net worth family office environment where, guess what? If you have a lot of money and I'm going to give it to a guy, you don't do a hedge fund, you do a managed account. In a managed account, you know exactly what's in that account at every single point of the day, right? So for us, this idea that you don't be transparent is like, well, what are you talking about? That's what we've always done. That's what's expected in the marketplace. And in one of our core beliefs is we believe in transparency, not black boxes. Now, going back to the mutual fund industry, there's all the evidence in the world, and I'm sure Jim has it memorized, where when you read academic literature, it's very clear that mutual funds as a whole underperform the S&P 500 by their fees, right? So if I'm a mutual fund company selling quote-unquote active products, it's most likely closet indexing effectively because most of them don't actually do active strategies where they hold high conviction, huge active share. I have this problem. I have no performance in reality. It's a bunch of noise, and I want to charge huge fees. One of the things you can do is sell everything, because it's a sales business. If I make it proprietary and cloak and dagger about my fancy, process that I'm doing to add all this value, you need to have some cover, because when you look at the evidence, it's clear it ain't there, right? You're not outperforming after your fees. So I think what's going on personally is that the reason a lot of 800-pound gorillas are afraid of transparency is not about front running, right? If you're trading Microsoft and Oracle, okay, fine, I'm trading Microsoft today. Good luck front running that, right? Maybe if you're doing small caps, that would matter. I think it's more about the marketing pitch. It's much harder to pitch when you got to be transparent that, all these great researcher guys in the background are doing all this extra value, even though my performance doesn't reflect any value add. It's easier to do the pitch when you can say I'm a proprietary, fancy shop.
And just to clarify what you mean by front running, so the idea, that's technically illegal, right? You can't.
Well, yeah,
but the idea is that if I know that this fund is going into this particular stock, whatever, can I, as a small trader or speculator, get ahead of that and somehow, ride the coattails of that?
Well, it's not illegal, really, because like Susquehanna down the street, like you can front run Russell 2000 rebalances, 500 index. Reggie can probably tell you all about it. That's what market making prop business is. Knowing where the flow's going, if you get ahead of that.
Yeah, I'm not sure if you could use the word. I'm not a lawyer, but I'm not sure.
Well, yeah, but the idea is...
You could say prepositioning.
Yeah, prepositioning, right, exactly.
There's other words for it. But,
yeah.
But your point is that...
The point is, it's a smoke and mirrors ploy that I think most people are trying to hide behind.
Right.
And that's why they don't want transparency.
It's not the front-running issue. It's really about the performance.
Yeah.
That if I have to show this on a daily basis, somehow I get exposed.
Well, and from academic research, right, like mutual funds have to disclose quarterly. We can figure out their factor exposures. We know their kind of turnover rate. So even if I see your portfolio quarterly, guess what? I can predict with 99% what you're going to hold every single day, effectively, right? So just because you only disclose quarterly as opposed to daily, from a quant perspective, I know what you're holding anyway. So you had to disclose quarterly. I know your turnover. I know your beta and your factor exposures. So it's not like your portfolio is not transparent already. It's just you got to be a little smart about finding that transparency. But there's a lot of PhD guys that obviously know how to do that. Mm-hmm. So again, the transparency thing I think is just a marketing ploy. And that's why we don't care about it.
Different take on it? Or?
I do. I think you said a lot of key words there. I don't want to repeat those words. But I'll just add this. One, there's a lot of pressure on firms on how they retain margins in their core business around distribution, and historically how folks are paid to market mutual funds. Because of competition and because of ETFs, there's margin compression where folks are making less money. And when I say folks, I mean firms are making less money because the outflows of mutual funds converting to ETF assets, and there's not the inherent mechanism to compensate firms to market mutual funds, market ETFs like mutual funds. So the word kickback is really just around how folks are compensated to sell financial instruments. And so that leads me into a very large point. In my view, ETF firms were born from mom and pop creations in someone's garage, creating ideas, and then launched in the ETF space. So you have a lot of firms that are in middle markets that were born within the last 10 years offering ETFs, and you have big firms like Vanguard, State Street, BlackRock coming into the space. The new next adopters of ETF platforms are going to be all the asset managers, meaning Fidelity, American Funds, T. Rowe Price. They are going to merge and buy all the middle market ETF firms, and then the next landscape in 3 to 5 years will be Vanguard, State Street, T. Rowe Price, American Funds, Federated, all the big complexes. And so what you're going to find within 5 years, mutual fund conversion into ETF form, and you'll have less mutual funds and more ETFs traded on secondary marketplaces because of delivery of solutions to investors globally. A very large part of my business is marketing to European clients, South American clients, and Canadian clients using American listed ETFs. And because of rules like FACTA, meaning that foreign investors must file their disclosures, you're finding a lot of pressures where home country bias is pushing investors to other countries adopting ETFs, and because of those pressures, you'll find assets more globalized. I call it NAFTA for financial advice.
Okay.
So you'll find that. So.
Okay. So do you see then competition with a Canadian firm then? You're talking like NAFTA was one of the big things, if you remember NAFTA from
Sure.
the early 90s or whatever.
Sure.
Concern was, in fact, there was a presidential candidate, Ross Perot. He had he was trying to compete to win the presidential election. He talked about NAFTA in very negative terms, and he said, you're going to see this huge sucking sound as all your jobs get pulled down to Mexico. And it didn't really work out that way. But so you're not saying anything that's controversial as that you're going to have a brain drain out of this country, or is it going to be the other way around? You're saying
what I'm saying, you're going to see a flattening of financial advice, and then you're going to find lower barriers for other firms to globalize their operations and launch exchange-traded mutual funds in other markets to meet the needs of local investors and countries. And so my biggest growth market as a market maker is Israel. We see a lot of opportunity marketing Israel for U.S. ETFs as a market maker. And then historically, we were very strong in Chile, Colombia, Peru, Mexico, because of pension plans using ETFs listed in the U.S. and Europe. So all those pressures will create additional pressures on U.S. mutual fund complexes to convert into ETF format.
Right.
Now, and Reggie, just thinking through that, and knowing a lot of those folks that do those, and knowing that they're already hiring the McKinseys and BCGs of the world to figure out this transition, clearly there's a major issue with cannibalization of the old business and the profit margin, where they've kind of, unlike Vanguard, where everything's like lean and mean and keep costs low as part of the culture, like a lot of mutual fund complexes, they have fancy offices in Manhattan, and they're, and they have to do that transition to active ETF. How do they logically make that without shooting themselves in the foot? Like, how do you see that going down?
Well, I think that's the big debate in the press today, where we as an industry is trying to find a vehicle for active managers to launch their intellectual property in an ETF format while protecting their intellectual property by delivering solutions to the marketplace. And that structure is in debate on what's best for the manager, what's best for the least informed investor, the retail community in mass, and then what's best for the industry overall. And that debate is very robust. And so you have active ETFs currently listed on exchanges, fixed income format, and I guess the most famous active managed ETF would be the former PIMCO Bill Ross gross ETF that we launched a couple of years ago. That's all about getting close to an all-star manager in a delivery format that's easy and cheap. And so I think that the debate is still raging. Everyone in the community is part of that debate. including Vanguard. I know I'm part of it directly. And it's really about suitability. Suitability of what's best for the industry, what's best for retail consumers, and what is the safest structure possible so that it withstands pressure going stress. Mm-hmm. We just don't know yet.
Okay. So since we have two horses in the race, I'll straddle the middle here, right? Unlike the aforementioned PIMCO fund, right, where it's mutual fund and its ETF are actually two completely separate legal entities, two sets of overhead, just two different things. When it comes to Vanguard ETFs, right, our ETF is nothing more than a separate share class of the same index fund of conventional mutual fund shares. So if you're familiar with the mutual fund world, right, you might see something as an A share, B share, C share, but it's the same fund. It's the same concept with Vanguard Total Stock Market Index, the Vanguard 500, whatever. We have investor shares, Admiral shares, and ETF shares. So investors who may buy our mutual fund index fund and or they buy shares of our ETF, cash flow goes to one single portfolio. So it's kind of a good feeling when I get to say every day when I get asked, Jim, do you direct investors to your mutual funds, your ETF? I can honestly say I don't care. I don't care which one you pick. I care you pick which one you think is best for you, and I care that you trust Vanguard with your indexing dollars. So, from that standpoint, we're happy to be able to offer both because it's the same fund.
Yeah, it's basically two different doors to the same destination, same home.
Yep.
Okay. How do you separate the capital gains and taxes in the mutual fund entity and the ETF entity?
Capital gains and taxes are all shared pro rata. It's just another share class.
I think we had some other questions here, so it's been a really good discussion here. So let's turn it over to the audience a little bit. I think this gentleman right here, Jeremiah, I think had a question. Then we'll go to the back.
That's my question, but are we alluding to eventually the death of mutual funds, or asked differently, at some point, 5 to 10 years, is there still a space for the 40 Act mutual fund makes sense sort of after all these flows kind of settle?
I think there is in strategies that have high risk of. Maybe we don't use front running, but I'm not going to do a micro cap, small cap strategy in ETF, right? Because I got to post my book every day, and some quant guy from Susquehanna down the street knows my algorithm. Even if it's active, they're going to be able to figure it out through statistics. If they know I'm holding $200 million small company, they're going to buy that ahead of time. I'm going to get killed on front running, like the R2K index. It drops 1% a year from people knowing the rebalance is coming in and out. So I think there's always going to be a role where that IP protection actually does become relevant, and it's going to be relevant in things like this. And those small caps, micro caps, esoteric strategies, maybe super high frequency strategies where it's actually too dangerous to disclose everything out there, because then you got quant geeks, front running you and killing the whole strategy. And that's something you're never going to want in an ETF, I think. That's going to always be in a managed account, an LP structure, or maybe a mutual fund. So there's definitely an area where IP protection becomes, outweighs the benefits of tax efficiency, transparency, client friendliness. But it's going to be a much smaller pool because all the capital is in, the big, deep, liquid equity and bond markets, and those should be in ETFs.
Can I go with the parallel universe theory?
Sure.
So let's assume for the past 70 some odd years, the only way investors could invest was in this thing called an ETF, right? It would be something that offered you broad diversification at pretty reasonable costs, but the only way you could buy and sell shares if you had to go onto an exchange, and maybe you incur brokerage commissions, you have to face bid-ask spreads, you know how to properly place your orders, and your investments settle on a T+3 basis. All right, in addition to getting a market price, not necessarily a spot-on NAV. So 25 years ago in Canada, or let's say a decade ago, in the United States, what's now popular is this new thing called the mutual fund. I don't incur a brokerage commission. I don't have bid-ask spreads. My dividends are reinvested directly automatically, and I work on a T+1 basis. Good chance we're all talking about how wonderful this new thing, the mutual fund, is, and is it going to steal the lunch from ETFs? Now, I don't say that to say ETFs will or will not continue to gain share against mutual funds. I'm only saying it's an interesting exercise that there are features of both that may be desirable to a certain set of investors, and that same set of investors might not like the features of the other one. So in very many ways, there are overwhelming amounts of similarities between these two different types of investor products, and it really does come down to what the individual is interested in terms of which one is more preferred to him or her.
Okay. Nicely said. I think is it Jerry in the back there?
Yeah, I'd like to explore a little bit deeper the difference between Vanguard ETFs as a separate share class as opposed to the more traditional structure. Could you just compare and contrast the advantages, detriments to either structure, not only from the ETF holder's perspective, but from the Vanguard, Admiral shareholder who's had those shares for 20 years now? Are there benefits there? And then which structure do you feel is more conducive to the active managed ETF environment?
I'll leave part two to Wes. Part one, the advantage, I think, Gus, is very simple. It's about scale, right? When you have investors who choose a particular index strategy, right? And as Mike alluded to, it's like a house, right? I'm trying to fill the house with furniture. I need beds, and I need a couch, and I need tables. I don't care if it comes through the side door, back door, garage door, whatever. It's all going to the same place, right? So all of these, all the cash flow that comes into our funds that goes to a portfolio. And when you're talking about things like total bond market index with 9,000 some odd bonds, total stock market index with over 3,000 stocks, you get the scale into one portfolio as opposed to having multiple, right? Scale gets you better ability to replicate the index. Scale gets you economies of scale. And I think a pretty good algebraic formula is if I own more securities and I charge less, that's probably going to lead to pretty darn good index tracking. And I think that is clear in a way beyond any of the other maybe arguments such as tax efficiency gets thrown out there as the number one reason to own an ETF. For us, we view it as scale. Because if I own more, if I almost replicate or fully replicate the index and I charge you less, you get pretty good tracking on top of that.
Yeah, so I agree with a lot of what Jim said, but on the tax thing, I think there's a huge differentiation here, right? Whereas Vanguard, if I'm holding, market cap weighted indices, buy and hold forever, and I don't transact a lot, of course the marginal benefit between a mutual fund structure and ETF is basically zero, right? I'm not distributing anything in the mutual fund, I'm not distributing anything in the ETF. However, the minute we start engaging in activity, we now have to pay Uncle Sam a 50% performance fee every year, right? If we have a vehicle or we have a strategy that is active and actually does transact a lot, and we're now moving away from value-weighted portfolios that basically just self-rebalance forever, clearly taxes matter. And every insanely rich guy I know, they tell me straight up, I'm not the smartest guy in the world, but I know how to defer taxes better than anyone. And guess what? When you compound 1 plus R and not 1 plus R, 1 minus T, 1 plus R goes a lot higher, a lot quicker over a long 20, 30-year horizon. So we believe that if you're doing anything that's active at any reasonable degree, if you do that in a hedge fund structure, a managed account structure, or anything like that where you can tax manage it to death, right? You can hold it for 1 year and a day. You can short-term tax harvest. You can hire Parametric or Wealthfront, whoever the hell it is. They can try to minimize tax leakage. There's a lot of vehicles I know of that can help you on the tax front, but the one that's available to like normal people like us and not being a billionaire is the ETF. The ETF wrapper to us is a way to take the major disadvantage of active management, aside from the fees, which Vanguard solved that problem, is the tax problem. And so to us, we just see the ETF as a way to finally deliver active management in a tax-efficient way. And a mutual fund just simply is not going to do that. You get a fat 1099 every year, which is a problem.
Just to clarify that, so for those out there not familiar with the ins and outs of the kind of the tax differences there. Mutual fund, if you have a realized gain, any dividends during the year, by law, you have to distribute 90% of those realized gains and dividends, by the end of that fiscal year. With an ETF, you can actively, like Wes was saying, you can trade in and out. You can have short-term capital gains. And the way the structure is set up is that when that exchange happens, when they buy one stock and then they sell it for a profit and switch it into another stock, that becomes a transfer in kind. It's not a taxable event. So literally the only time you have to really take a tax hit, so to speak, with an ETF is when you sell it, which could be 20 years from now, other than any kind of realized dividends along the way. So there is a true tax efficiency differential if you're active. I think Jim is right, though. I think if you just passively hold a market cap weighted index, that thing doesn't trade that much. You're not getting a lot of those realized gains, and therefore you don't have as much taxes anyway, even in a mutual fund structure. So just to clarify those two things here. And yes, sir.
Listening to the stories of Mr. Brown, especially in going into these less efficient markets like Peru or the high-yield bond market. Now, you've got a guy with $1 billion who wants just to broadly buy all these high-yield bonds, and that market's relatively inefficient. Do you worry that when people just go out and do an ETF where they just buy across the board, that this could even lower efficiency more and lower liquidity? Because what you've got is somebody, instead of actually doing the groundwork and analyzing individual securities, that making the picks that are going to actually get them correctly priced, instead of just buying across the board, you've got somebody could actually go out there and say, oh, this one is this price, I'm going to buy it, so the price adjusts. And so there may be actually lower efficiency from the growth of ETFs.
Well, I think I'll answer your question this way. Because of Vanguard has been a champion of passive investing, index-based investing, ETFs follow the same philosophy, where you just buy the index, you buy the strip of underlying instruments, and you get exposure. And because of passive investing, one could argue that correlations are higher, because instead of just buying fundamental based on a certain security set, based on its fundamental factors, you're buying the whole suite. You can say that the entire suite is now moving its same characteristic despite fundamental factors. So I think that because of ETFs, the transactional efficiency is at its all-time high on the bonds that are inside of ETFs, because people are trading them back and forth, and there's a lot of dealers focused on that line of fixed income of instruments. If you're not included in a passive vehicle, so let's say there's a bond that's not included, there's less liquidity because there's less dealers focused on instruments that are on the outset of non-passive investing vehicles. So say it cleanly and plainly. If you're included inside of an index, that instrument most likely has higher trading volume. It probably trades like its other counterparts. If you're not part of a passive investment index, it's less likely that there'll be liquidity in that instrument. So if you look at the fixed income markets, it's very opaque. It's very tough to get liquidity in a number of bonds because no inventory. There's not any investment banks holding inventory any longer. And so finding price transparency in those bonds is difficult, expensive, because there's not a lot of market makers focused on it. That's the problem in the United States, because market structure has created this bifurcated system where if you're included, you have liquidity. If you're not included, you can't find it. And so ETFs are allowing, I believe, higher efficiency because the prices of those securities is at its all-time close to bid-ask spread, and liquidity in those bonds are very high. So if you wanted to move a yard is $1 billion in high-yield ETFs, there are two, J&K by State Street, HYG by iShares. I can move $100 million within 10 basis points very easily because the market allows that. If I wanted to trade other bonds of high yield, not in ETF format, those spreads are 4 times as wide.
So there's one thing I want to add, because an area of research of mine is this concept of this discussion about indexing and securities being more correlated. And I've published a lot of different papers and blogs on this topic, right, that don't confuse correlation with dispersion. Right? Correlation tells you the direction of securities. It does not tell you the magnitude by which they move. So again, to use the I'm going to use the Russell 3000, right? Over the past 8 years, I can tell you whether or not Russell 3000 stocks have tended to move directionally by more or less than they have historically. But no matter whether or not they go up or down, they still have